Let's now quickly revise Accounting Standard 28, which is Chapter 5, Unit 7 of your syllabus. This is impairment of assets. Impairment is decrease in the value of the asset other than by way of depreciation, other than by way of downward revaluation. Depreciation is systematic allocation. Systematically, we allocate over the useful life. Downward revaluation is when we feel the assets value is much lower than what it is. We have charted lesser depreciation in the previous years, so we do downward revaluation. What is impairment? Impairment is an indication that the asset's economic benefit has dropped because of some factor. That factor can be external factor, factor can be internal factor. Like the asset that is used, using that we are manufacturing some products, a significant fall has happened in the units manufactured using that asset, or there is significant decrease in the market price for that product only, or there is a one new technology that has come because of which this is outdated, efficiency has dropped, or something happened because of which it went down. Interest rates have been moved by the government in such a way that it will no longer be beneficial to do this business, or people's choices have changed, material has become obsolete, you are planning to discontinue, you are going for a reconstruction, or the asset has started performing poorly though it has longer useful. All of these are the indicators. We will not be knowing to do impairment. If any of this indicator triggers, that's when we do impair. How do we do impairment? Very simple. We will think of the asset. Asset can be seen in two ways. One, use the asset till the day it dies. Second one, sell the asset today. When I see this asset, I feel like, should I use this till the time it stops working, or should I sell it right now? Let's say this is my asset, which I'm trying to identify impairment for. I will see if I use this asset till the day it dies, how much benefit will I get? I will check. If I give, let's say I'm giving this phone on rent. I give this phone on rent for every month, I'll collect 500 rupees as rent. So how many years can I give this phone on rent? I will do an estimate. I can give it for 2 more years on rent. 500 rupees per month. For 12 months, it comes to 6,000. Another 12 months, it comes to 6,000. Can I say my annual receipt for this 6,000 for first year, 6,000 for second year, 12,000. But you will not receive 6,000 today. I'll receive 6,000 after year one. I'll receive another 6,000 after year. Assuming that I'll collect the rental annually, I'll discount first 6,000 for 1 year. I'll discount second 6,000 for 2 years for an assumed internal rate of return. I will get the present value of cash flows this will generate to me in the future. That is value in use. What is that? Value in use. If I use this, how much value will I get from that? Value in its usage. Second option, I will not use it. I will sell it today only. Net selling price. Net 10K from the selling price. I will deduct the expense I'm incurring for sale. Someone will tell that they will buy this phone. I'll tell I'll buy this phone, but change the battery and game. I'll buy this phone, but remove this case, put one new case and give. I'll buy this phone, change the charger point and give. So to sell it, I might have to incur some expense. Or someone will tell that they will sell it on my behalf, but they want 10% commission. So from selling price, if I deduct selling expenses, I'll get net selling price. I told you I have two options with the phone. Number one, use it till it dies. I'll take the cash flows that it will generate in the future, discount it to today's date. I will identify the second one, net selling price, the value that I'll get if I sell this asset. I will compare both. I'll compare both value in use and net selling price. Whichever gives me higher cash flow, that is what I'll pick. No, let's say the present value of the future cash flows comes to 9,000. But if I sell it today, I'll get 10,000. What should I do? Sell today. So I'll pick the bigger option. I am not selling. I'm telling that we should pick the bigger option. 10,000 is called as recoverable amount. Higher of net selling price and value in use will be considered as recoverable amount. Amount that will be recovered from the asset when we take the best possible option. This will be compared with carrying amount. Let's say recoverable amount is 10,000. Asset is in there in my balance sheet at 15,000. So I've recorded the asset at 15. Best possible option if I take also, I'll be able to generate only 10,000. So this 5,000 is decrease in the value of the asset. This is not loss on sale. Why? I have not sold. This is not downward revaluation. Why? This is not arising because of wrong depreciation in the past. This is not depreciation because this is not systematic allocation. Then what is this? Impairment loss. What is this? This will be charged to P&L account. Now comes the most interesting part. This impairment loss is not calculated for each individual asset. We will do it for one smallest identifiable group of assets. I'll give you a better example. In this classroom now, the what to say the benches are saying that they pay 10,000 rupees to sit on me for 1 month. So my value in use is 10,000 rupees per month. Is that right? No. The same bench, if I put it on the street, people won't pay 10,000 to sit on the bench. Projector will say people pay 60,000 rupees to listen to me for 6 months. Every year I'll generate 60,000 rupees per student into 300 students. That is my value in use. Is that the thing? No. Projector is having the value because I am teaching. Same projector, if you put on the street or anywhere else, project something else, it won't generate so much of cash. Are you getting it? So it is not individual asset that is generating cash flow. Individually, for projector or bench, I am not able to identify cash flow. Projector, the screen, chairs, benches, fans, AC, speaker, mic, camera, table, this laptop, everything together is one CGU, cash generating unit. It is smallest identifiable group of assets against which we can identify cash. There is a chair in theater. Can that chair say people pay 500 rupees to sit on me for 3 hours? My value in use, cash flow that I'll generate, 500 rupees into 4 shows per day, into 365 days in a year. Share was bought for 20,000. Can it say 20 lakh is its see what to say value in use? No. Alone chair no one is paying to see. They're paying to sit on the chair because the theater, it is there inside the theater. So the chair, projector, screen, ambience, everything together, it is one CG. So we will do impairment not for individual assets but for an entire CG. Cash generating unit. And same is the concept of corporate assets. Whenever we purchase a CGU, whenever we purchase a CGU, we might sometimes end up paying more money than the value of the CGU. I purchased an entire cash generating unit. I ended up paying more than the value of that CGU. I bought 5 assets together. Asset 1, 2, 3, 4, 5. All the 5 assets together, individually the assets will come to 100 rupees. Like asset 1 plus asset 2 plus asset 3, asset 4, asset 5. If I buy, the value comes to 100 lakhs. Okay. Asset 1 is 20, asset 2 is 20, asset 3 is 24, is 25, is 20. But the businessman is not selling individual assets, selling all the 5 assets together. They ended up paying him 130 lakhs. I paid 30 lakhs extra. That is goodwill. That is, I see 5 assets which I bought 20, 20, 20, 20 each. Value 100, but I paid 130. 30 lakhs what I paid extra is the sixth asset. What I don't see. Intangible asset, goodwill. Now, when we are checking impairment, first we should take this goodwill is there, no? 30 lakhs. This should be allocated to all the assets on a reasonable and consistent basis. 30 lakhs will be divided by 5. 6 lakh, 6 lakh, 6 lakh, 6 lakh, 6 lakh, I'll add. Each of the assets carrying amount became 26. Then, whichever asset is giving an indicator, only that asset I will check impairment. Understood? This is called as bottom-up test, where goodwill or corporate asset can be reasonably and consistently allocated. In our example of purchase of 5 assets together, when I incurred 30 lakhs extra creating goodwill, if I can allocate this 30 lakh goodwill to 5 individual assets, then reasonably and consistently, I can tell the reason why I'm allocating this much value to each of it. Consistent. The method that I follow to share goodwill to each of them this year, next to next year will be same. So I will share goodwill 30 lakhs to individual assets. Check which assets is creating indicator. Asset 1 is creating indicator. Asset 1's carrying amount is 20 lakh plus 6 lakh goodwill, 26 lakh. Then I'll check the recoverable amount. If recoverable amount is less, then I will create impairment on this. If recoverable amount is more, no impairment. This test what I did is bottom up test. This test what we did is bottom up test. How to remember? Very easy. It can be allocated on reasonable and consistent basis. RCB. RCB ಯಾವತ್ತು table bottom in the topic ಹೋಗುತ್ತೆ. Bottom up test. You get what I'm trying to tell? What if there is no reasonable consistent basis? Meaning this goodwill of 30, it cannot be allocated to any of these assets. Then what do? Then this asset is there, no, which is having indicator 20 lakhs without adding goodwill. 20 lakhs itself is its carrying value. Compare it with the recoverable amount. Identify impairment loss. After you identified impairment loss and reduce the value of this asset number 1, then take asset 1, asset 2, asset 3, asset 4, asset 5. All the assets carrying amount together. So that you add goodwill also of 30. That is one bigger CGU now. That entire CGU's recoverable amount you identify compared to identify impairment loss. That impairment loss has to be booked again. What is this? Individual one asset you did know. That is bottom up test. You are not satisfied with that. Why? In that individual asset, we did not add goodwill. There is a chances that goodwill also can be impaired. In AS 26, when we discussed, we should check impairment for goodwill every year. So this impairment on goodwill has to be identified. So goodwill cannot be allocated to any of this. And goodwill alone, we can't do impairment. Why? Goodwill will not have cash inflows individually. No, there is no value in use. There is no net selling price to this. So what do? Goodwill belongs to all the 5 assets together. For asset number 1, do bottom up test. Then revised carrying amount after impairment loss of asset 1. Then asset 2, 3, 4, 5 together you take. Add goodwill to it. Total CGU is there, no? Larger CGU. That entire CGU's value in use and NSP you find. Compare it with recoverable amount and find impairment loss. Second time. That, my friends, is top down test. Top we go through, no? Playoffs admire will come back to the bottom. RCB, or say it cannot be allocated on reasonable and consistent basis. So RCB, yes, bottom up test. Share goodwill, then impairment. If goodwill cannot be allocated without sharing goodwill, individual asset impairment, then add goodwill to all the assets together, then check impairment. Now the next point is, what do we do with this impairment loss? ಎಲ್ಲಿಗೆ ಕಳಿಸಬೇಕು? Impairment loss should be reduced from the cost of the asset and should be charged to P&L. Impairment loss should be reduced from the cost of the asset and charged to P&L. If in case there is impairment loss, once again, if in case there is impairment loss and there is revaluation reserve. See, impairment loss is 10. We have balance in revaluation reserve. Don't charge impairment loss to P&L. Adjust it against revaluation reserve. If impairment loss is greater than revaluation reserve, only then it will go to P&L. See here, impairment loss is 10. Revaluation reserve is 12. Don't transfer impairment loss of 10 to P&L. Adjust entire 10 impairment loss against revaluation reserve. And 0 will be transferred to P&L. 12 is the balance in revaluation reserve. After adjusting 10 of impairment loss, 2 will be still remaining in revaluation reserve. If impairment loss is 10, revaluation reserve is 8, then revaluation reserve will become 0. Because impairment loss is 10, we adjust against revaluation reserve 8. Excess of 2 only will be charged at P&L. You got it? So impairment loss should be transferred to P&L and also deducted from asset. Before you transfer to P&L, someone stops you. Who? Revaluation reserve. Only after you close revaluation reserve, you should transfer to P&L. For example, when you're shooting revaluation reserve, in front of you, you are shooting it to P&L. Revaluation reserve will come and say, kill me before you kill P&L. So before you shoot P&L, you should kill revaluation reserve. After you kill revaluation reserve only, you shoot P&L. This is the one side. The other side is, we should reduce from the cost of the asset. Before you reduce from the cost of the asset, you should reduce goodwill. You should reduce goodwill. Before you shoot your impairment loss towards asset, no, goodwill will come. If you have to kill the asset, kill me first. So first you will shoot goodwill, dishkum. Goodwill will die. Then you will shoot the asset. That is a treatment. This is basic recognition of impairment loss. Next point that we have is reversal. At any point of time, if any of the pointers that you just identified gets reversed, indicators gets reversed, cash flows will increase, discounting rates will change, and indicators get reversed, then you reverse the impairment loss. You get what I'm trying to tell? That's the only point that you should know with regard to impairment reversal. And I hope this short revision video on accounting standard 28 was of some use to all of you people.